If you had $5,000 today, what would you actually do with it? Probably feel a bit guilty spending it and a bit nervous investing it, because spending $5,000 feels like a lot of money, and for investing, it doesn't feel significant enough to really matter or make a difference. In this video, I'm going to show you how I'd actually handle this. First, I'll walk you through the 2 decisions every investor should understand before investing a single dollar. Then I'll show you the portfolio skeleton, 3 buckets with 3 jobs, how I'd split the $5,000 across them, and what it looks like once everything is working together. And in the end, I'll show you how this exact portfolio could potentially turn a one-time $5,000 investment into more than $350,000 over time, proving that $5,000 isn't insignificant when it comes to investing. Now, before we talk about any assets or numbers, there's something more important to get right, because the way this portfolio ends up looking has less to do with the funds themselves and more to do with the decisions you make before you invest a single dollar. So before we touch the $5,000, we need to make 2 decisions. Decision number 1 is simple on the surface, but most people never slow down enough to answer it properly. What job does this $5,000 actually have? See, money can do a lot of things, but for investing, it usually falls into one of 3 jobs. The first job is growth. Growth means this money is trying to become meaningfully larger over time. Most of the return comes from price appreciation. The account balance moves around a lot from year to year. Some years feel amazing, other years feel uncomfortable. Income is not the priority here. Growth portfolios trade smoothness for compounding. The second job is income, which means this money is meant to pay you regularly. The focus isn't on growing the account balance as fast as possible, but instead on producing cash flow you can rely on. Income-focused investments tend to feel more stable, but the trade-off is slower long-term growth. The third job is flexibility. Flexibility means optionality, liquidity, the ability to act when opportunities show up. Flexible money gives you control, but on its own, it doesn't compound very well. It waits, it protects, it gives you choices. None of these jobs are wrong. The problem is mixing them up. So for this video, I'm choosing deliberately. This $5,000 is not emergency money. It's not money I need in the coming years. Time is the advantage. And when time is on your side, growth has historically done most of the heavy lifting. That doesn't mean growth is easy. It means you're accepting discomfort in exchange for higher expected returns over long periods. It also means you have to design the portfolio in a way that makes staying invested possible. Which brings us to the second decision. How much pain can you actually handle? A 20% drawdown doesn't sound scary until you attach it to real money. On $5,000, that's watching $1,000 disappear on paper. A 30% drop feels even worse, and those kinds of moves are normal for growth-focused portfolios. If you don't account for that up front, you don't fail because the strategy was bad, you fail because living with it becomes impossible. Once the goal is clear, the portfolio structure stops feeling complicated. You're no longer asking what's popular or what did well last year. You're asking a much simpler question. What tools actually help a growth-focused portfolio survive long enough to compound? I think about this portfolio as 3 buckets, each with a very specific job. None of them is here by accident, and none of them is trying to do everything at once. The first bucket is the growth bucket. This is where most of the long-term compounding comes from. In this portfolio, that role is filled by U.S. technology through VGT. VGT holds large established technology companies that drive a huge portion of global innovation and earnings growth. It has a very low dividend yield, around 0.4%, because almost all of the return shows up through price appreciation. Historically, that price appreciation has been strong, averaging a little over 22% per year across long periods, though never in a straight line. This is the part of the portfolio that makes the volatility worth it. It'll have years where it feels unstoppable and years where it feels uncomfortable. That's the cost of asking your money to grow aggressively over time. The second bucket is the global backup. Growth doesn't only happen in one country, and no single market gets to dominate forever. That's where international stocks come in through VXUS. VXUS gives exposure to companies across Europe, Asia, and emerging markets. Compared to US tech, the growth is slower and the price appreciation has historically been more modest, closer to mid-single digits. But this bucket behaves differently across cycles. It also pays a higher dividend, close to 3%, with dividend growth that has been meaningfully higher than US averages. The job here isn't to beat US tech, it's to reduce the risk of tying your entire future to one market and one economic path. Over long periods, that kind of diversification smooths out the returns. The third bucket is the shock absorber. This is the part most growth portfolios skip, and it's usually where problems start. In this portfolio, that role is filled by gold through GLD. Gold doesn't pay income, it doesn't produce earnings, and it doesn't grow in the same way stocks do. Its value comes from behaving differently when confidence breaks down. Over very long periods, gold has still delivered positive returns, but those returns show up in bursts, not smooth lines. Over the last 10 years, gold has delivered a compound annual return of about 16%, but for projections, I'm not using that number. To avoid recency bias, I'm assuming a more conservative 8 to 10% long-term average, which is closer to what gold has maintained across its full history. And those returns don't show up smoothly. Gold tends to move in bursts, long, flat periods followed by sharp moves, usually when other assets are under pressure. The point of this bucket isn't to chase returns, it's to change how the portfolio behaves during stress. When you put these three buckets together, you get a portfolio with three things built in: growth, international exposure, and protection. Each part has a clear job. This is not a completely growth-focused portfolio yet, however. Next, I'll show you how I would allocate the $5,000 within this portfolio to make it more growth-focused. And in the end, I'll show you how this exact structure could potentially turn a one-time $5,000 investment into more than $350,000 over time. But first, let's see how to tilt this structure toward growth, how to maximize the return on your $5,000 without removing the protection that helps you stay invested when markets get messy. This is the part people usually obsess over, but by the time you get here, the heavy lifting is already done. Out of the $5,000, half will go to the growth bucket, 50% into VGT. That's the part doing the aggressive compounding. It's volatile, it won't feel smooth, and it won't look smart every year. But if this portfolio is going to grow meaningfully over time, this is where most of that growth has to come from. 30% will go into the global backup bucket through VXUS. Again, this isn't to outperform US tech, it's here to make sure the portfolio isn't hostage to one country, one economy, or one market cycle. It adds diversification, different growth patterns, and a steadier income component without changing the overall growth focus. The remaining 20% will go into the safety bucket, the shock absorber, through GLD. This is the piece that most people question, especially in a growth portfolio, but this allocation isn't about chasing returns only, it's about survival too. Gold exists here to change the experience during market stress, not to dominate long-term performance. Even with this allocation, the portfolio is still, historically, growth-heavy. Now, just as important as what's included is what's deliberately excluded. I'm not concentrating this portfolio into a handful of stocks, no matter how exciting they look. I'm not chasing last year's best performer, and I'm not building something that only works on paper but falls apart emotionally during a bad year. This allocation is a result of the earlier decisions. Growth was chosen on purpose. Pain tolerance was acknowledged up front. The weights simply reflect that logic. Now that everything is combined into one portfolio, the next step is to look at it honestly, not asset by asset, but as a whole. Because what matters isn't how each piece behaves on its own, it's how the portfolio behaves when you actually own it. When you put everything together, this portfolio has a dividend yield of just over 1%. That immediately tells you something important. This is not designed to pay you income. If income were the goal, this would be the wrong setup. Dividend growth across the portfolio has averaged under 3%. That's steady, but again, it reinforces the same point. Income grows slowly here, and that is intentional. Where the portfolio earns its keep is price appreciation. Historically, the combined average has been a little over 15%. That's the engine. That's what drives the long-term outcome. Now we can finally run the future projections and see what kind of return this portfolio could generate if we invest $5,000 into it. After 1 year, based on the portfolio's metrics, that $5,000 is projected to grow to about $5,800. After 10 years, that original $5,000 is projected to grow to roughly $21,600. At this point, compounding starts to become noticeable. After 20 years, the projected value gets close to $89,600. This is where time is expected to do more of the work than effort. And after 30 years, that same $5,000 is projected to be worth around $367,000. Now, look at where that projected value is expected to come from. Over those 30 years, the total value added is projected to be about $362,000. Almost all of that is expected to come from capital appreciation, roughly $360,000. Dividend reinvestment is projected to contribute only about $2,000. This portfolio is not designed to generate income. Even after 30 years, the annual dividends are projected to only be around $78, which works out to about $6 per month. That is not a failure. That's the trade-off working exactly as intended. The heavy lifting is done by price growth, not payouts. Want to see how a simple dividend portfolio can generate $4,800 a month, starting with as little as $20 a week? Click the video on the screen to see exactly how it's built.